When you work a 9-5, taxes are invisible. They disappear before you ever touch the money. Your employer takes them, files them, and hands you a W-2 in January like nothing happened. When you go self-employed, taxes become very visible and very large and entirely your problem. Most people find this out the hard way sometime around April when they sit down to file and discover they owe $4, $5, sometimes $8,000 they never set aside. No warning, no preparation, just a number on a screen and a sinking feeling. And the worst part, nobody teaches you this. Not the business coach who told you to quit your job, not the accountant you hired after the fact, not the IRS, which is extremely happy to let you figure it out on your own and then charge you a penalty for being surprised. In this case file, we're going to break down exactly how taxes work when you work for yourself, what changed the moment you stopped being an employee, how the quarterly payment system works, which deductions you're probably missing, and the one move that can cut your tax bill significantly once your income reaches a certain level. This is not theoretical. If you are self-employed right now, freelancing, running a small business, doing contract work, and you don't have a system for this, you are building a liability on your balance sheet every single day. Let's close that case. Here is the thing your employer never told you. When you had a job, they were paying half your taxes without you ever seeing it. Every working American pays into Social Security and Medicare. The combined rate is 15.3%, but on a W-2 that cost is split down the middle. You pay 7.65%. Your employer pays 7.65% silently, in addition to your salary, without it ever appearing on your paycheck. So when you made $60,000 at your job, the true cost to your employer was closer to $64,590. That extra $4,590, you never saw it, you never missed it. It just disappeared into the system. The moment you go self-employed, that disappears. There is no employer, which means you now pay both halves, all 15.3%. That is called the self-employment tax, and it is the single most common financial shock that new freelancers and business owners experience in their first year. Let's open Exhibit A, the self-employment tax. The rate is 15.3%. It breaks down as 12.4% for Social Security, which applies to your first $168,600 of net self-employment income in 2024, and 2.9% for Medicare, which has no cap. But here is the key detail. You don't pay 15.3% on your gross income. You pay it on 92.35% of your net self-employment income. The IRS gives you a small discount to account for the deductible portion. The math looks complicated, but the practical number to remember is this. Plan for roughly 14 to 15 cents of every dollar in self-employment tax before you even touch federal income tax. Let's run the actual numbers so this isn't abstract. Say you go self-employed and earn $60,000 net in your first year. Your self-employment tax is $60,000 times 92.35% times 15.3%. That comes out to approximately $8,478. That's just SE tax. On top of that, you owe federal income tax on your taxable income, which gets reduced by a few deductions we'll cover shortly, but let's call it roughly $7,000 to $9,000 more depending on your situation. Total tax bill in year one, somewhere between $15,000 and $18,000. For someone who came from a W-2 and has never set money aside, that number arrives like a rogue wave. Exhibit B, the quarterly estimated payment system. As a W-2 employee, your employer withheld your taxes automatically every paycheck. The IRS received money from you 12 times a year, evenly spread out. When you go self-employed, you are required to replicate that system yourself by sending the IRS estimated payments 4 times a year. The due dates are April 15th, June 15th, September 15th, and January 15th of the following year. Miss these deadlines and the IRS charges an underpayment penalty. Not huge, but real and avoidable. How much do you send each quarter? There are 2 safe harbor options. Option 1, pay at least 90% of what you'll owe this year. Requires you to estimate your income accurately, difficult when you're building a business with variable revenue. Option 2, pay 100% of what you owed last year. This is almost always easier. Look at last year's total tax bill from your 1040, divide by 4, send that amount each quarter. The IRS cannot penalize you if you hit that number, regardless of what you earn this year. If your income was over $150,000 last year, the threshold increases to 110% of last year's tax. Write that down. Here is the simplest self-employment tax system that actually works. Open a separate savings account, not your checking account, not your business operating account. Call it tax reserve. Every time money comes in, move 30% of it into that account immediately, not at the end of the month, not when it's convenient, immediately. That 30% covers self-employment tax, federal income tax, and in most states, state income tax. For lower income years, it will be slightly more than you need. For higher income years, it may be slightly less, but it keeps you from spending money that was never really yours. Exhibit C, what you can actually deduct. This is where being self-employed starts to work in your favor. The tax code gives business owners access to deductions that employees simply don't have. Let's go through the most significant ones. The first deduction almost nobody mentions in year one. You can deduct half of your self-employment tax from your gross income, not from your SC tax calculation, from your adjusted gross income on your federal return. Using our $60,000 example, the SC tax was $8,478. Half of that, $4,239, gets subtracted directly from your income before the IRS calculates what you owe in federal income tax. The IRS gives you this deduction to recognize that your employer would have paid this in a traditional job. It's not huge, but it's real money and it's automatic. Deduction 2, if you pay for your own health insurance, those premiums are fully deductible above the line, meaning they reduce your adjusted gross income directly. This is one of the most valuable deductions available to the self-employed. If you're paying $400 a month for a plan, that's $4,800 a year that reduces your taxable income before you even itemize. We covered the routes to health insurance without an employer in an earlier case file, and this is one of the financial levers that makes that decision more workable. Deduction 3, and this is the one that changes everything once your income reaches a certain level, retirement contributions. As a self-employed person, you can open a S-Corp IRA and contribute up to 25% of your net self-employment income, capped at $69,000 in 2024. Every dollar you put in reduces your taxable income dollar for dollar. A freelancer earning $80,000 who contributes $16,000 to a S-Corp IRA just reduced their taxable income by $16,000. The tax savings depend on their bracket, but at 22%, that's $3,520 back in their pocket, plus the long-term compounding of the investment itself. The solo 401k is another option, with higher contribution limits and more flexibility, worth researching once your income stabilizes. This is Layer 3 and Layer 4 content operating simultaneously. Deduction 4, ordinary and necessary business expenses. Home office, if you use part of your home exclusively and regularly for business, you can deduct it. The simplified method allows $5 per square foot up to 300 square feet for a maximum deduction of $1,500. Clean, simple, defensible. Equipment, software, subscriptions, a portion of your phone bill, business travel, professional development, these reduce your net self-employment income, which in turn reduces both your SC tax and your income tax. Keep receipts, categorize everything. Your future self in April will thank you. Exhibit D, where people get this badly wrong. The most common mistake is treating gross revenue as income. A freelancer invoices $80,000 in a year, feels prosperous, spends like they're making $80,000, and then discovers in April that their tax bill is $18,000 they no longer have. The second most common mistake is confusing a good quarter for a good year and skipping quarterly payments. One missed payment doesn't feel significant in the moment. 2 missed payments and the penalty adds up. And the final payment in January, covering Q4, often arrives just after the holidays when accounts are at their lowest. Plan for it explicitly. Now, for those of you who watched the LLC case file, this is where the S-Corp election enters the picture again. Once your net self-employment income consistently exceeds roughly $40,000 to $50,000 a year, you should be evaluating the S-Corp election. Here's why it matters for taxes specifically. As an S-Corp owner, you split your income into 2 buckets, a reasonable salary, which is subject to employment taxes, and distributions from the business, which are not. If you net $100,000 and pay yourself a $60,000 salary, you pay SC equivalent taxes on $60,000. The remaining $40,000 comes to you as a distribution, no self-employment tax. At 15.3%, that's over $6,000 in tax savings. The S-Corp has costs, payroll processing, additional accounting, but past a certain income level, the math favors it clearly. Let's close the case. When you go self-employed, 2 things happen to your taxes. You become responsible for the full 15.3% self-employment tax that your employer used to split with you, and you become responsible for paying quarterly instead of having withholding done automatically. The playbook is straightforward. Move 30% of every payment into a tax reserve account immediately. Pay quarterly by the deadlines. Deduct what you're entitled to: half of SE tax, health insurance, retirement contributions, business expenses. And once your income clears $50,000 consistently, evaluate the S-Corp election with a CPA. The IRS does not send reminders when you're late. It does not call to tell you that you missed a quarterly payment. It simply charges you a penalty and waits. That is not a system designed for your success. Build yours deliberately. Protect your earnings the same way you build them, with a plan, not with hope. Which part of this did your employer never explain to you? Tell me in the comments. And if you haven't watched the LLC case file yet, watch that next. The S-Corp election we just covered only applies if your structure is set up correctly first. Links in the description. Deduce your way to treasure.